We have a massive stack of forensic macro analysis files today.
A seriously massive stack.
Yeah, and I'll be honest, right up front, I spent basically the entire weekend trying to poke holes in this dossier.
Because it sounds crazy.
It sounds like something straight out of a paranoid Reddit thread, honestly. But welcome to the deep dive.
Glad to be here.
Today, we're tearing into what the analysts who compiled these sources are calling the ETF Trojan Horse.
Right.
And the core of this entire investigation starts with a single, highly specific market anomaly that I think, anyone who trades crypto has probably noticed by now.
Oh, absolutely.
Every single trading day, right around 10 a.m. Eastern time, Bitcoin takes a sudden, sharp dive.
Like clockwork.
Yeah, usually in the neighborhood of 2 to 3%. And my immediate reaction when I read the executive summary was just a massive eye roll.
You thought it was just regular chop.
Exactly. Because to me, that is just standard market structure. I mean, it's 10:00 a.m. in New York. The traditional equities market has been open for 30 minutes. Macro data drops usually happen at 8:30 or 10:00.
European markets are heading to their close.
Right, European close. You have delta hedging going on. You have day traders taking overnight profits off the table. Standard order book rebalancing.
It looks perfectly normal.
Yeah, it's just the organic, choppy movement of a highly volatile asset class reacting to the traditional finance workday. So suggesting there's some boogeyman behind the 10:00 a.m. dump felt like a massive stretch to me.
And it's completely understandable to write it off as organic chop at first glance because, honestly, that is exactly what the traditional finance architecture wants you to think.
Right.
But the deeper you get into these forensic files, the faster that theory of natural market forces just completely disintegrates.
Which is wild.
It is. What we are looking at in these documents is not a coincidence.
Right.
It is entirely divorced from organic, news-driven price action. The sources we are unpacking today meticulously outline a highly coordinated algorithmic strategy. And you, as the listener, really need to understand the gravity of this. This strategy has a singular, ruthless purpose. It is designed to methodically slaughter retail traders and harvest their liquidity.
Man, slaughter.
Yeah. Today, we're going completely under the hood of institutional market mechanics. We're going to decode the reality that Wall Street didn't surrender to decentralized money.
They built a trap.
They built a capture mechanism to farm it. And most importantly, we're going to walk you through the exact mathematical playbook for stepping completely outside their algorithmic dragnet.
See, that idea that Wall Street didn't surrender, but rather built a capture mechanism that is a hell of a hook.
It changes everything.
It really does. So our mission for this deep dive is to synthesize these highly detailed dossiers. We're going to look at how the institutional market plumbing actually functions beneath the surface.
The boring stuff that's actually terrifying.
Right, exactly.
Yeah.
We're going to zero in on the specific and honestly highly privileged role of authorized participants and dissect a multi-billion-dollar quantitative algorithm that explicitly targets that 10:00 a.m. window.
Yeah.
But before we get into the weeds of the algorithm itself, we really need to set the stage.
Yeah.
Because I remember the vibe when the spot ETFs were finally approved.
We all do.
It was pure euphoria.
It really was. If you look back at the market sentiment data from that period, the public, the retail sector, the heavily entrenched online communities, they were universally popping champagne.
Laser eyes everywhere.
Exactly. The dominant narrative plastered across every financial media outlet was that the cypherpunks had won.
Yeah.
Dumb money had somehow outlasted the legacy system. The story was that the suits in Manhattan, the mega asset managers, had finally capitulated.
We realized they couldn't beat it.
Right. They couldn't regulate decentralized money out of existence. They couldn't ban it, so they were forced to just join the network.
And, I mean, from a mainstream pragmatic perspective, that felt entirely accurate at the time. The approval unlocked the floodgates for hundreds of billions of dollars in dormant institutional capital.
Massive inflows.
Suddenly, registered investment advisors could allocate client portfolios to the space without all that regulatory ambiguity.
Yeah.
Everyday people could get exposure right inside their 401ks and IRAs. You didn't have to navigate seed phrases or sketchy offshore exchanges anymore.
It was convenient.
Super convenient. The market viewed it as the ultimate indisputable bridge to global mass adoption. So where does this dossier argue that the celebration went off the rails?
Well, the celebration basically ignored Wall Street's actual documented historical behavior.
Okay.
The analysts in these files make a really profound point. Wall Street does not surrender. They assimilate.
They financialize it.
Exactly, they financialize. The concept detailed extensively in the first section of these sources is referred to as the decoy.
The decode.
Right. The spot ETFs were brilliantly packaged and presented to the public as this great democratizing vehicle.
Like a Trojan horse.
Exactly like a Trojan horse. The underlying architecture, the actual granular plumbing of how these financial products are created, redeemed, and maintained was fundamentally designed from the ground up to benefit the legacy institutions at the direct expense of the everyday market participant.
Okay, I hear the theory, but let's push back on this assimilation idea a little
Sure,
bit.
here.
You're talking about the decoy, but an ETF is just a wrapper.
Yeah.
It's a standard securitization model we've seen with gold, with commodities, with basically everything.
Yeah.
So why is this specific wrapper inherently predatory? That brings us right back to this 10-0-0 anomaly. You're saying the wrapper facilitates this drop.
It does.
But again, I look at 10-0 AM and I just see peak traditional market liquidity. Why couldn't this just be, VWAP algorithms executing large institutional buy or sell orders over a specific time horizon? Why does it have to be a predatory trap?
Because of the strict mathematical consistency and the direct, measurable consequence of the timing.
Walk me through that.
So the forensic evidence presented here shows that for months following the ETF approvals, this pattern wasn't just occasional, it wasn't random, it was an industrial scale operation.
Okay.
A sudden, violent 2 to 3% suppression of the spot price, engineered perfectly around 10:0 a.m.
Right.
And the consequence of that exact percentage drop is the absolute tell. It wasn't just moving the market, it was consistently triggering hundreds of millions of dollars in cascading liquidations across the retail perpetual futures markets.
Oh, so you're arguing the drop is calibrated specifically to hit the resting stop losses and liquidation levels of the retail derivatives market.
Precisely. If it were just organic VWAP execution, you would see varied sizing, varied timing, and you'd see a reaction to actual macro data.
It wouldn't be every single day at the exact same time.
Exactly. Instead, the data in the dossier shows a surgical strike. It's an alarm clock, and that's what breaks the natural volatility defense.
Right.
Natural volatility doesn't clock in for a shift at exactly 10:0 a.m. to perform the exact same percentage haircut.
No, it doesn't.
To understand how a legacy institution can mathematically force that outcome without blowing themselves up in the process, we have to open the file on what the industry insiders call the Authorized Participant Loophole.
All right, let's get into the plumbing. If we're going to accuse massive financial institutions of running a daily liquidation farm, we need to prove they actually have the mechanical leverage to do it.
We do.
Because the dossier spends a massive amount of time deconstructing the ETF middleman. So let's talk about authorized participants. I think most people fundamentally misunderstand what they're actually holding when they buy an ETF.
They absolutely do.
When you fire up your brokerage app and you buy 100 shares of a massive fund, let's just use the BlackRock spot fund as the proxy here.
No.
You are not buying decentralized, bearer asset cryptocurrency.
Not even close. You are buying a traditional security. You are buying a paper claim on a trust that supposedly holds the underlying asset.
Right, a paper claim.
But for that wrapper to function, for the price of that paper share to closely track the real-time, highly volatile spot price of the underlying asset across global exchanges, the system requires an active, heavily capitalized intermediary.
Right.
Enter the authorized participant, or the AP. Their sole mandate is to facilitate creation and redemption baskets. They provide the market liquidity that keeps the ETF price pegged to the net asset value of the underlying holdings.
And the sources point a very bright spotlight at one firm in particular when discussing these AP mechanics, which is Jane Street.
Yes, Jane Street.
Now, for the listener who might only know the retail side of the crypto market, we need to establish the sheer, terrifying scale of a firm like Jane Street.
They are massive.
They aren't just some proprietary trading desk throwing around a few $1 million.
Yeah.
They are an absolute behemoth in the quantitative trading space. The files note they handle over 10% of all U.S. equity trading volume.
10%.
10%. Let that sink in. 1 out of every 10 trades in the traditional stock market flows through their algorithms.
It's staggering.
And they serve as a primary, exclusive, authorized participant for the largest spot crypto ETFs in the world.
Which naturally leads right to the defense you were raising earlier.
Exactly. If I'm playing the skeptic, the immediate glaring question is regulatory oversight.
Of course.
If a firm is responsible for 10% of all U.S. equities, they have the SEC, the CFTC, and FINRA literally living inside their servers.
They're under a microscope.
Right. They are one of the most heavily scrutinized financial entities on the planet. The idea that they could just blatantly manipulate the price of a trillion-dollar asset class every single morning without Gary Gensler or the enforcement divisions dropping the hammer on them, it seems completely unhinged.
It does seem unhinged until you read the actual regulatory exemptions buried in the market structure.
Okay.
And this is where the dossier gets incredibly dark. The files outline the core loophole that makes this entire operation legally viable.
Let's hear it.
Because APs are officially designated as vital liquidity providers, because the SEC desperately needs them to ensure these massive ETFs don't trade at wild premiums or discounts to the underlying asset, the regulatory framework grants them legal superpowers.
Superpowers.
Literally superpowers that no standard hedge fund and certainly no retail trader possesses.
We are talking about Reg SHO.
Yes, Regulation SHO. It's the framework implemented back in 2005, specifically designed to prevent abusive short-selling practices.
Right.
It was supposed to stop naked shorting, which is the practice of selling shares you haven't actually located or borrowed, which can artificially dilute the float and crash a stock.
Yeah. Under standard rules, if you or I want to short an asset, we have to pay a borrow fee, locate the asset, and take on the margin risk.
But the APs get a free pass.
A free pass.
They get what's called the bona fide market-making exception.
Ah.
The SEC's rationale is that if an AP is constantly quoting bids and asks to provide liquidity to the market, they can't be bogged down by the strict requirements of locating the asset before every single microsecond transaction.
That would slow everything down.
Exactly. So they are legally permitted to naked short. They are allowed to sell massive quantities of the ETF or the underlying asset that they do not currently hold under the premise that they will eventually acquire it to settle the trade.
I mean, I understand the SEC's logic there to an extent. In a highly fragmented, fast-moving market, if a market maker had to hard locate every single share before filling a massive influx of retail buy orders, the bid-ask spreads would blow out to ridiculous levels.
Yeah, it would be unworkable.
The market would become incredibly illiquid and inefficient. So the SEC says, fine, you're a trusted AP, you can short without locating just to keep the plumbing flowing smoothly, as long as you eventually balance your books. But the dossier argues this exact exemption for smooth plumbing is being weaponized.
It is entirely weaponized because the Reg SHO exemption isn't even the most dangerous part of the architecture.
It gets worse.
Oh, yeah. The true fatal trap for the retail market lies in the profound information asymmetry surrounding their reporting requirements.
Okay, let's dig deep into this reporting asymmetry, because this was the moment in the files where my skepticism actually started to crack.
It's the linchpin.
As an authorized participant, as a massive institutional player, you are legally required to file 13F reports and publicly disclose your long positions.
Right.
So at the end of the quarter, the filings hit the wire, and everyone can see that Jane Street or whoever is holding, let's say, $800 million worth of the spot ETF.
And consider the psychological impact of that public filing on the broader market. How does the retail sector interpret that data?
Well, it creates massive FOMO. It looks incredibly bullish. You have all the crypto analytics accounts on Twitter scraping the 13F filings and blasting out headlines. Institutional adoption is here. Megaquants hold $1 billion in spot ETFs. The everyday trader looks at that and thinks, the smartest guys in the room, the guys with the supercomputers, are massively long. We are going to the moon. They are on our side.
And it provides the ultimate cover, because what the retail trader does not see, what the regulatory framework explicitly does not force these firms to disclose publicly, is the other side of their book.
The dark side.
Right. They do not have to report their over-the-counter derivatives, their offshore swaps, or their intricate short positions in real time.
So they can hold an $800 million long position in the heavily regulated, highly visible U.S. ETF market, completely satisfying the SEC and looking like crypto evangelists,
while simultaneously holding a multi-billion-dollar, highly leveraged, completely opaque short position in the offshore perpetual futures markets.
Wow.
They project a massive, highly visible decoy to the public, while entirely in the shadows, they build a private guillotine.
Private guillotine.
Yeah. This isn't just a basic delta-neutral hedge to protect their inventory. As the analysts point out, when you combine the AP superpower to short without restriction and the total lack of transparency on their derivatives book, it stops being a defensive hedge.
It becomes a weapon.
It becomes an active, predatory hunting mechanism.
A private guillotine. That is a brutal way to put it. But it perfectly transitions us into the third section of the dossier, which outlines exactly how this hunting mechanism is operationalized.
Let's get into the mechanics.
Because holding a hidden short position doesn't do you any good unless you can guarantee the market is going to crash and make that short profitable.
Exactly.
And this is where we get into what the analysts call the liquidation farm. We need to walk through the step-by-step forensic mechanics of the 10:00 a.m. dump.
To understand the mechanics of the slaughter, you first have to understand the psychology and the vulnerability of the prey. The institutional algorithms are hunting something very specific.
Retail leverage.
Retail leverage.
And we all know how the retail crypto market operates. It is fundamentally addicted to leverage.
Addicted is the right word.
You have an entire ecosystem of offshore exchanges offering 50x, 100x perpetual futures contracts. Traders are putting up $1,000 of collateral to control $100,000 in position sizing.
Trying to get rich quick.
Yeah, they are amplifying their buying power because they want life-changing wealth overnight.
But that amplification means their liquidation price is incredibly tight.
Very tight.
If the market moves against them by even a tiny fraction of a percent, the exchange engine forcefully closes their position, liquidates their collateral, and dumps their underlying asset into the open market.
Without them doing a thing.
Exactly. The golden rule presented in these files is absolute. In this market structure, if you use leverage, you are not the trader. You are the product. You are the exact liquidity that the institutional algorithms are engineered to harvest.
All right, so the prey is over-leveraged and totally vulnerable to these tight tripwires. Let's break down the 5-step playbook detailed in the forensic files. How does a firm like this engineer a daily harvest without taking on massive directional risk themselves?
Step 1 happens entirely in the dark.
Okay.
Utilizing their offshore entities or complex OTC swap desks, the institution builds up a massive, entirely hidden short position. They are betting heavily that the price will drop.
And because of the reporting asymmetry we just discussed, nobody sees it.
Right. The broader market is completely blind to this massive overhead pressure.
The trap is set.
The trap is set. Step 2 is timing the execution. The algorithm waits for a very specific market microstructure environment, a low liquidity window.
Which brings us back to 10:00 a.m.
Yes, and this is why your earlier defense of the 10:00 a.m. timing actually plays right into their hands.
Wait, how does 10:00 a.m. provide a low liquidity window? I argued that was peak traditional market hours.
It is peak for traditional equities, but look closely at the crypto order book depth at that exact hour.
Okay, what happens to the order book?
The frantic, high-volume arbitrage that happens right at the 9:30 a.m. New York Open has settled down. The initial wave of retail day traders reacting to morning news has exhausted their capital. The order books on major crypto exchanges tend to thin out slightly around 10:00 a.m. A thin order book simply means there is less resting capital. Fewer limit buy orders group tightly around the current spot price.
Less padding.
Right. When liquidity thins out, it requires significantly less physical capital to force the price of an asset to slip aggressively downward.
Ah, I see. So it's a pocket of vulnerability. They aren't fighting the peak 9:30 a.m. volume. They are waiting for the exhaustion lull at 10 a.m.
Precisely.
Okay, so we have the hidden shorts placed, and we have a thin order book. That brings us to step 3, the trigger.
The trigger.
The dossier states the firm takes a chunk of actual physical spot asset, not the paper EPF, but the real underlying asset, and they aggressively market sell it all at once. They just dump it right into the thin order book.
Exactly. Because the order book is thin, that sudden influx of aggressive sell pressure causes massive slippage.
Just cuts right through.
It instantly suppresses the price, creating an artificial, violent plunge. Usually that 2 to 3% drop we identified at the very beginning.
And that leads directly to step 4.
Which the analysts label the cascade.
The cascade. This is where the math gets incredibly elegant and honestly incredibly ruthless.
Yeah.
That sudden 2% drop created by the firm's spot dump, that is precisely calibrated to hit the densest clusters of retail liquidation levels.
They know exactly where the stops are.
Exactly. The algorithm knows exactly where the retail stop losses and liquidation tripwires are resting. When the price hits that level, the exchange engines automatically take over.
The exchanges do the dirty work.
They start forcefully liquidating the retail accounts, which means they're automatically firing market sell orders into an already falling market.
And what happens when thousands of highly leveraged retail positions are forcefully market sold at the exact same millisecond?
It creates a feedback loop, a tidal wave of automated selling pressure. The retail panic and the exchange algorithms completely take over the downward momentum.
The firm that initiated the dump doesn't have to spend another dime.
Nothing. The price drops from 2% to 3% to 4%, just slicing through order book support levels like a hot knife through butter.
Yep.
The avalanche they started with a relatively small snowball completely buries the retail market.
And right at the bottom of that cascade, when the maximum amount of retail blood is in the streets, the firm executes the second half of step 4.
Which is?
They quietly close out those massive hidden short positions they built up in step 1.
For an astronomical profit.
Exactly. They engineered the crash, they knew the exact depth of the cascade they could trigger, and they monetized the panic.
That is insane.
The profit generated from closing out those highly leveraged hidden derivatives exponentially dwarfs whatever minor calculated loss they might have taken by intentionally dumping their spot holdings at a lower price in step 3.
Which brings us to step 5. And the realization here completely shifted my perspective on this entire market structure.
It's the cherry on top.
It really is. The firm just made an absolute killing on their hidden shorts. They have a massive influx of fresh capital. What do?
They turn right around and deploy those profits to buy back the exact same spot asset they dumped in step 3.
But now they're buying it at the artificially suppressed, heavily discounted price caused by the retail liquidation cascade.
By buying back in massive volume at the bottom, they instantly inject bullish momentum back into the market.
It snaps right back.
They push the price back up to its normal equilibrium. The anomaly basically self-corrects.
So if you are just a casual observer looking at a daily chart, it just looks like a brief, unfortunate wick. Just a quick blip of morning volatility.
Just normal crypto stuff.
Right. But beneath the surface of that chart, millions of dollars in wealth have been surgically extracted from over-leveraged retail traders and transferred directly into the vaults of the institutional quants.
When you break down the 5 steps, the true nature of step 3, that initial market sell of the spot asset, is completely recontextualized.
It isn't a panic sell.
No. The firm isn't reducing their exposure because they think the asset is fundamentally weak. That initial dump is literally a loss leader.
Like at a grocery store.
Exactly. It's the exact same psychology as a massive grocery chain selling milk below cost just to get you in the door to buy high-margin products.
Wow.
The institution intentionally takes a temporary hit on a block of spot inventory, using it purely as a mathematical battering ram to trigger the retail liquidation engines, all so they can cash out the real prize, which is the hidden derivatives.
It is the clinical sociopathic efficiency of algorithmic finance applied to a highly emotional, hyper-leveraged retail ecosystem.
That's a great way to describe it.
And the sheer brilliance of the scheme, from the perspective of the legacy system, is that it is virtually indistinguishable from organic market movement to the untrained eye, or, frankly, to the underfunded regulator.
It looks completely natural.
Okay, I have to step back into the shoes of the skeptic here for a minute.
Go for it.
Because while this 5-step playbook is fascinating,
Yeah.
and it makes perfect mathematical and theoretical sense, I mean, it clearly illustrates the motive, the means, and the opportunity, we are still talking about a theory.
Sure.
Wall Street is full of theoretical strategies that never actually survive the real world. The listener is probably thinking, okay, this sounds like a really elegant conspiracy cooked up by a bunch of frustrated crypto day traders who got liquidated and want to blame the suits instead of their own bad risk management.
That's a valid pushback.
Right. So is there actual hard forensic proof that massive institutional firms are executing this specific strategy, or is this just macro-level paranoia?
That is the pivotal question of this entire deep dive.
Let's answer it.
It is one thing to outline an elegant theoretical mechanism. It is entirely another to prove it is being weaponized in the wild. And the reason these sources are so compelling is that they do not rely on conjecture.
They bring the receipts.
They provide the legal receipts. They document deeply established behavioral precedents for this exact algorithmic pattern. Let's pull up Files 04 in the dossier.
Files 04, the SEBI ban.
Yes. If anyone dismisses this as retail paranoia, they need to look at the actions of international sovereign regulators. Let's look at July of 2025.
Okay.
The Securities and Exchange Board of India SEBI, which is effectively India's equivalent of the SEC, did not just launch a polite fact-finding inquiry into Jane Street's operation.
They went way further than that.
They outright banned the firm from trading in the country and immediately moved to freeze over $500 million of their capital.
A $500 million asset freeze by a G20 nation's primary regulator. That is not a slap on the wrist for a minor compliance failure.
No, it's not.
That is the regulatory equivalent of a nuclear strike. What was the specific data anomaly that caused SEBI to drop the hammer?
SEBI's forensic data scientists identified the exact same algorithmic fingerprint we just discussed.
The 5-step playbook.
They charged the firm with deploying a highly coordinated algorithmic manipulation strategy across Indian equities. SEBI didn't just see random volatility. Their filings cited a distinct morning pump, afternoon dump cycle.
Timing-based order book manipulation.
Exactly. The regulator explicitly concluded that this pattern was not organic market making or legitimate hedging, but a predatory algorithm designed entirely to harvest liquidity, exploit market microstructure, and trigger directional cascades.
So we have a major sophisticated national regulator officially documenting, isolating, and severely penalizing the exact behavioral logic we laid out in the 5-step playbook.
The receipts are there.
The willingness to use immense capital weight to artificially move an order book to trigger structural liquidity events. It's proven.
It's a documented precedent.
But the dossier doesn't stop with traditional equities in India. It moves to Files 05, which brings the methodology directly into the heart of the cryptocurrency ecosystem.
Files 05 covers the Terra Luna lawsuit.
Oh boy.
And to grasp the gravity of this litigation, we have to briefly revisit the carnage of the 2022 crypto crash.
A lot of people are still hurting from that one.
The Terra Luna ecosystem, anchored by the UST algorithmic stablecoin, was a $40 billion financial experiment that catastrophically unraveled in a matter of days.
Just a total death spiral.
It was a systemic contagion event that wiped out the life savings of millions of retail participants globally and dragged down half the industry with it.
And according to the filings we are reviewing, Jane Street is currently facing a massive lawsuit directly entangled in that $40 billion death spiral.
The specific allegations in this suit are wild.
They really are. The plaintiffs allege that the firm deliberately hired a former quantitative intern directly from Terraform Labs.
Which is the development company that built the Terra ecosystem.
Right. And the allegation isn't that they just wanted his coding skills or whatever. The lawsuit claims they hired him specifically to acquire highly guarded, non-public insider information about the specific structural vulnerabilities of the algorithmic peg.
Specifically, they allegedly wanted the exact parameters of the liquidity pools on decentralized exchanges like Curve Finance, which defended the UST peg.
They wanted the blueprints to the vault.
And what does the lawsuit claim they did with that proprietary architectural knowledge? It alleges they weaponized it.
Shocker.
They supposedly used that asymmetric information advantage to aggressively, methodically short the Terra Luna ecosystem right before its historic collapse.
Meaning they positioned their derivatives book to profit astronomically from the destruction of the asset, exploiting the precise vulnerabilities they allegedly uncovered.
That's the allegation.
So, if we look at the board, we have a documented history of severe regulatory bans for algorithmic order book manipulation in India, and a massive ongoing legal battle alleging the exploitation of insider architecture to execute catastrophic short selling in the decentralized finance space.
It establishes a massive behavioral precedent.
It absolutely does.
Yeah.
But honestly, as I read through the dossier, neither the SEBI ban nor the Terra lawsuit was the thing that finally broke my skepticism. No. The final piece of forensic evidence, the ultimate smoking gun buried in the data correlation, is what made me realize the analysts were absolutely right.
You were referring to the behavioral correlation regarding the 10.0 a.m. anomaly itself.
Yes. The dossier overlays the timeline of the 10.0 a.m. dumps with the timeline of the legal filings.
It's incredible.
The very week that the Terra Luna lawsuit went public, when it hit the international financial press, when it became a massive trending topic on crypto Twitter, and suddenly a blinding spotlight of regulatory and public scrutiny swung directly onto Jane Street's crypto trading desks.
What happened to the Bitcoin market?
The daily 10.0 a.m. drops completely stopped.
Instantly.
Instantly. The algorithmic alarm clock was abruptly unplugged.
The very second the heat was on, the so-called natural volatility of the 10.0 a.m. New York session vanished into thin air.
Poof.
No more daily 3% cascades. No more massive liquidation spikes right after breakfast.
And what was the immediate market reaction once that artificial daily suppression mechanism was lifted? Bitcoin ripped upward. It surged 10% in just 48 hours.
It's hard to argue with that data.
You really can't. When you stack the SEBI regulatory ban, the Terra Luna insider trading allegations, and the undeniable mathematical correlation of the suppression algorithm shutting off the exact moment the lawsuit dropped, my skepticism died.
Yeah, the data is utterly indisputable. This is a highly coordinated, intentional extraction strategy.
It is.
And this realization raises a profound question. It brings us to the ultimate synthesis of this entire investigation.
Let's hear it.
When you look at the totality of the evidence, the Reg SHO loopholes, the authorized participant exemptions, the liquidation farms, the international legal precedents, you have to realize this is not merely a story about one bad actor firm pushing the ethical or legal boundaries of a market.
It's bigger than that.
Much bigger. This is a story about the fundamental nature of the financial system itself.
That is a critical distinction. We aren't just talking about a rogue trader writing a malicious script. We're talking about the architecture of the arena. The system doesn't consider this a bug. It considers this a feature.
Exactly. When you take a natively decentralized bearer asset, like Bitcoin, and you demand that it be securitized through the traditional plumbing of Wall Street by wrapping it in an ETF,
You inevitably invite Wall Street's rules.
you invite their highly privileged middlemen, you invite their opaque regulatory exemptions, and you invite their apex predator liquidity harvesting algorithms. It's a package deal. The cypherpunks in the retail market celebrated the ETF as a total victory, but the forensic reality is that the legacy financial system simply assimilated the asset on its own terms within an arena where they completely control the physics.
So we arrive at the so what of the deep dive. We've outlined the mechanics of the trap, we've gone deep into the institutional plumbing, and we've shown the legal receipts. What does this actually mean for you, the listener?
It can feel overwhelming.
It's easy to feel completely overwhelmed or utterly defeated by the scale of the manipulation. But the analysts who put this dossier together don't just leave us with doom and gloom.
No, they don't.
They provide a highly actionable, highly effective playbook for escaping the dragnet, the Smart Money Survival Guide.
And that survival guide begins with rule number 1, which is non-negotiable if you want to survive in this market structure.
Avoid leverage completely.
Avoid leverage completely.
Seriously, if there is only one concept you internalize from this entire deep dive, it has to be this. We all see the massive flexes on social media, the guys posting screenshots of 50x long positions that hit big.
It's tempting.
It is. But when you trade with borrowed money on these platforms, you are willingly walking onto the liquidation farm wearing a neon target on your back.
Yep.
You are mathematically offering your capital up as the exact liquidity that these multi-billion-dollar algorithms are hunting.
The 10 a.m. spot dumps only work. The cascades only happen because retail traders are wildly overleveraged and resting their stops right below the current price.
Right. So if you transition to a spot-only trading strategy, if you only use cash you actually possess, and only buy the asset outright, a sudden, violent 3% algorithmic drop doesn't force you into a margin call.
You don't get liquidated.
You don't. You can just look at the volatility, recognize it for the artificial manipulation it is, and simply wait it out.
Eliminating leverage is the absolute foundation of defense. If you trade with cash, you remove your capital from the cascade equation entirely, which brings us to rule number 2.
You must deeply understand the ETF trade-off.
Right. Because you argued earlier that ETFs provided a massive utility for traditional retirement accounts, and to be fair, the dossier acknowledges that.
Yeah. If your singular goal is to get price exposure inside a highly tax-advantaged environment like a Roth IRA, and you don't care about the underlying ethos of the asset, the ETF wrapper serves a purpose.
It does, but you must consciously accept the philosophical and systemic cost of that convenience. By choosing to hold a paper ETF share instead of the bearer asset, you are explicitly placing your trust, your wealth, and your market access directly in the hands of the very financial intermediaries that cryptographic money was invented to bypass.
You're jumping back into the cage.
You are accepting the AP loopholes, the massive hidden derivatives pressure, and the securitized manipulation as the unavoidable cost of doing business in their arena.
Which perfectly sets up the final, ultimate solution provided in the dossier.
The ultimate firewall.
If you want absolute mathematical immunity from these algorithmic games, there is only one definitive firewall left. Self-custody.
This is where the narrative loops all the way back to the fundamental promise of decentralized architecture.
It really does.
Self-custody, holding your own cryptographic keys completely independent of any centralized exchange or traditional financial wrapper, is the only true exit from the system.
The irony here is thick, honestly. The hardcore crypto maxes have been screaming, "Not your keys, not your coins," for over a decade, usually as a warning against centralized exchanges going bankrupt or getting hacked.
Like we saw with FTX.
Exactly, like FTX. But what these files demonstrate is that self-custody is actually the only viable mathematical defense against institutional price harvesting.
The profound conclusion of this entire analysis rests on the power dynamic of the cryptographic key.
Think about the reality we just mapped out. Wall Street, armed with billions of dollars in capital and a litany of regulatory superpowers, can manipulate the fiat exchange rate of the asset all they want.
They can dump spot inventory at 10 a.m. every single day.
They can engineer massive derivatives cascades to shake out the weak hands.
But
Their algorithms, no matter how sophisticated, absolutely cannot liquidate your self-custodied wallet.
they can't touch it.
If you hold your own keys, completely decoupled from the leverage engines and the centralized clearinghouses, the 10 a.m. dumps mean absolutely nothing to your underlying holdings.
You don't receive a margin call.
You don't get force liquidated by a matching engine. You watch the algorithmic 3% drop, and you simply ignore it because your underlying asset is mathematically immune to their harvest.
They can manipulate the tape, but they cannot touch the underlying network.
Mathematically immune. That completely flips the power dynamic. It takes away the fear of the volatility.
It restores the original intended physics of the technology.
Let's pull all of this together. We started with the mainstream illusion of Wall Street's surrender, the euphoria surrounding the ETF approvals,
We followed the forensic data to uncover the reality of the Trojan Horse.
detailing exactly how the authorized participant loopholes allow apex firms to obscure billion-dollar short positions and weaponize 10 to 000 a.m. low liquidity windows to trigger devastating retail liquidations.
We looked at the hard regulatory receipts from the SEBI ban in India to the Terra Luna insider trading allegations.
Proving this behavior is systemic and highly coordinated.
And we arrived at the fundamental truth of the asset. It was designed from its inception to exist outside the legacy financial architecture.
The securitized ETF was engineered to put it back in a cage, to domesticate it, and to extract yield from the very participants the technology was meant to empower.
You get to decide which version of the asset you own. Are you holding the paper claim inside the cage, subject to the algorithms, the loopholes, and the liquidation farms?
Or are you holding the keys to the vault yourself? Which leads me to our pinned question for you, the listener. Do you currently hold your exposure in self-custody, or do you prefer the tax-advantaged convenience of the Wall Street ETFs?
It is arguably the most consequential decision you can make regarding this asset class.
And as you ponder that decision, I want to leave you with a chilling extrapolation that builds on a very brief, almost throwaway detail hidden deep within the final pages of the dossier.
The analyst briefly mentioned the historical use of the offshore trust loophole.
Which are these complex legal structures traditionally used by the ultra-wealthy to protect their physical assets and wealth from aggressive government overreach or seizure?
The ultimate legacy asset protection strategy.
Exactly. Now, consider the trajectory we've just spent this entire deep dive mapping out. If Wall Street's ultimate goal, their most wildly profitable business model, relies on keeping the maximum amount of retail capital trapped inside their highly engineered ETF liquidation farms.
How long do you think it will be until their massive institutional lobbying arms turn their attention towards self-custody?
Oh man, that is a dark thought.
If self-custody is the only firewall making the retail investor mathematically immune to their algorithms, how soon until we start seeing highly coordinated regulatory campaigns funded by the legacy system claiming that holding your own keys is inherently unsafe, excessively risky, or fundamentally associated with illicit activity?
Painting it as a danger to the public.
Exactly. How long until they try to legally restrict or heavily penalize the very concept of an unhosted wallet, all while pushing their heavily manipulated fee-generating paper shares as the only approved way to participate?
If they successfully captured the asset with the ETF, the next logical step to protect their monopoly is to legally outlaw the escape pod.
Something to heavily mull over as you decide where to store your wealth in the coming decade.
The game never actually stops. They just continuously rewrite the rules to ensure the house always wins. Thank you for joining us on this deep dive. Stay curious, stay highly skeptical of the plumbing, and we'll catch you on the next one.